Good evening, I'm Mario Becker, founder and CEO of Das Family Office, a Singapore-based multi-family office and fund manager. And in the following video, I'm summarizing the events of the first quarter. Thanks a lot for your attention. The first quarter is already behind us and a lot has happened. Unfortunately, the war between Russia and Ukraine is ongoing. Then the same goes for the friction between the US and China, which doesn't seem to be abating. We have constant discussions on Taiwan and the future of Taiwan. This all looks rather scary, I would say. Then as far as China is concerned, we finally have witnessed the end of COVID-0, which was a big drag on the Chinese economy last year and should create a much better environment this year. But from what we're seeing so far, it's moving a bit slower than many people had hoped for. And the same goes for the inflation, which is coming down. Just today we received new inflation data from the US, but it's coming down much slower than everybody was hoping for, which is unexpected and makes people impatient. Then I guess one of the major events of the first quarter was the demise of SVB, Silicon Valley Bank, and the fact that we could see that US regional banks are not as solid as we thought. They needed the quick intervention by the Fed as well as the FDIC, which luckily happened. So from what we're seeing now, it looks like this banking crisis is more or less hopefully behind us. And what was also rather unexpected was the fact that Credit Suisse had to be taken over by UBS. It all happened very quickly and upset a lot of investors in the process, because bond investors or the holders of Tier 1 capital were treated differently from equity stakeholders, and it's not clear yet whether this decision will hold or whether in future some of that deal will have to be changed. But despite these many events and these many disturbances and frictions, we could actually witness that in the first quarter the global financial markets did actually surprisingly well. Global equities are up quite a bit, and also global bond markets have stabilized markedly and are typically up for the year. Especially long-dated bonds, which had suffered a lot last year, are up quite a bit this year in the range of 3 to 5%, sometimes a bit more. And global equities are also up more than 5%. What is quite interesting is that especially the laggards of last year, which were technology stocks and so-called quality stocks, that means stocks of companies that have superior profitability and market share, as at the same time lower indebtedness, they're doing much better in the first quarter this year. They managed to outperform value indices, and they managed to also outperform capital market weighted indices. This is the first time in many quarters, and from my perspective, this is a pleasant surprise, because I had been advocating a lot of the quality managers and quality indices, which didn't work out last year, but it's doing quite well this year, and that's sort of compensating for some of the losses we had to witness last year. The reason for that is most likely the fact that the quality indices and the quality managers tend to not invest in banks. Last year that has helped the broad-based indices and the so-called value indices. But this year, obviously, given what we've seen in the global, or most of all the European and the American banking sector, having no exposure to banks has proven to be quite good this year. The US dollar continues to be a bit softer. We've seen a small reprieve in February, but after today's inflation data, we continue to see the dollar go a bit weaker. That's something we had already discussed in January, and we basically expect that this will help the emerging markets this year, as well as companies that are heavily indebted in US dollar and are earning in other currencies. Europe is surprisingly strong. This is unexpected, especially also Germany, because given the fact that the Ukrainian war is ongoing, and it could well be that Europe has to go into a recession from all the data we're looking at. This is a surprise, but it may be related to the fact that China has opened up again, that COVID zero has come to an end, which tends to benefit German companies and also other European companies. The fact that financial markets are doing quite well in the first quarter also shows in our various investment building blocks. As you know, we have defined a universe of safety and return building blocks, which are typically bond and equity building blocks, and they're all doing quite well, especially the building blocks investing in long duration bonds. They're up quite a bit, although they cannot compensate just yet for the losses of last year. And the building blocks that are investing in short duration bonds are also up for the year, obviously not as much. Then the quality equity managers are up a lot, especially also the quality managers that are investing in smaller companies, which is again a pleasant surprise and buffers some of the losses we've seen last year, which is good. I mean, it's not unexpected, but it's good to see. And the same also goes for our model portfolios, as well as our standard portfolios from Dimensional Fund Advisors, which are global multi-factor portfolio models. They're all doing really well for the year, which is good because many of our investors are investing in those, and we continue to advocate them. The events related to Credit Suisse and the Silicon Valley Bank have actually shown us again that the fear of what happens to your term deposit and your bank deposits are alive and well, and we have to be really careful. I mean, luckily our clients and investors are not really holding a lot of cash. At the same time, we've been looking for solutions how to deal with situations where we just hold too much cash or where clients hold too much cash. And obviously there are the money market, all sorts of money market solutions. Typically our custodian banks all have money market funds, which tend to be quite well. It's important to know that they are all ring fenced. That means if any of the custodian banks were to go bankrupt, these money market funds wouldn't be part of the liquidation assets. So that is obviously an easy solution. They can be bought and sold every day at no fee. So they are a very good source of liquidity. In addition to that, we have identified two very attractive ultra short-term building blocks. We call them building blocks Purple 5 and Purple 6. And they're basically ETFs that are investing in floating rate notes with investment grade rating. Rating is about A-. And for very short duration government and investment grade bonds, the duration here is 7 months. And from what we've seen over the last many years, both building blocks have not seen any drawdown, which is very important because you've seen that even the global short duration investments have seen certain drawdowns, of 3 to 5%, which is very disappointing. And with the addition of these two building blocks, we think we have two very good solutions for holding cash. The current yield path are close to 5% in US dollars, which is higher than typical term deposits. So we would encourage you to look at these new building blocks and also talk to us about what we think about money market solutions, because obviously you don't want to get caught in some form of a bank bankruptcy or bank restructuring. That's something we clearly want to avoid. But luckily our investors are globally diversified. So this is more of a theoretical risk, but nevertheless, you may hold cash with other banks that we don't know of, and we're more than happy to help you here. So what should you do for the remainder of the year, or at least the coming quarter? I would suggest stay the course, just because the quality managers are doing quite well now. Shouldn't force you to change out of value strategies or capital market based index strategies. So stick with the strategy that you've decided to pursue. Don't change it. At the same time, the people or investors who decided to go with the quality managers, feel happy about the recovery and expect it to continue. Bond yields in US dollars are also attractive. They can effectively beat the break-even inflation rates. If I now look at today's break-even inflation rates for 10 years, they are 2.27%, and for 1 year it's 2.8%. So the financial market participants are clearly expecting inflation to continue to come off. So yeah, if you invest in high quality bonds, you're getting compensated for inflation, which is very good. The same goes for equity valuations. Current equity risk premia on the MSCI All Country World Index level are between 7 and 8%, clearly beating inflation. So current valuations are clearly attractive and should allow you to put your normal asset allocation to work. Bear in mind that we like to follow the fair horizon concept. That means with rising investment time horizon, you should increase your equity allocation, because otherwise you'll be leaving money on the table, because we're expecting global equities, global quality equities to deliver the highest long-term returns. One other asset class that I'd like to briefly highlight is Tier 1 capital. This is an asset class that we don't normally really highlight because it's a niche asset class. At the same time, it's very popular with private banks globally. This is effectively bank capital. It pays typically very high coupons. At the same time, it's exposed to the development of a given bank. If the Tier 1 capital, the equity capital of that given bank falls, there's a chance of these bonds being totally wiped out or being converted to stocks, or also being written down and then potentially not being written back. And we've witnessed in the case of the Credit Suisse takeover by UBS that all the Tier 1 capital of Credit Suisse was written down, more or less everything with a few exceptions. And there was a big disappointment, although fundamentally this was known to capital market participants, but I guess not everybody read the fine print, and now a lot of people are sitting on losses that they hate. But the fact of this drama with Credit Suisse Tier 1 capital has brought a lot of volatility into the whole asset class. So you can now get comparatively high quality Tier 1 capital from banks such as BNP Paribas, HSBC at yields that are actually higher than equity yields or equity risk premia. So you may want to look at this, but again, don't stuff your portfolio with Tier 1 capital now. It's a niche asset class. It could be an add-on, it could be a satellite investment. Please talk to us if you're really interested. We can tell you the differences between the various issuers and the various different issues and bonds. But it may be an opportunity. This is why I'd like to highlight it to you at this point. Apart from that, I wish you all the very best for the second quarter. Let's hope markets will continue to be stable, maybe with a little bit of an upward bias, but who knows. Don't wait up, put your money to work. It's better to be in the market than outside the market. Thanks a lot for listening. Yours truly, Mario Becker.